Leaving Canada without handling your bank accounts properly can lead to frozen funds, audits, and non compliant penalties. In this video, I'll explain what really happens to your Canadian bank accounts when you become a non resident and what steps you must take to protect your access and stay fully compliant. Most Canadians are surprised to learn that just moving abroad doesn't cut your financial ties automatically. I'll walk you through what the banks look for, how the CRA monitors non residents, and what my clients do to avoid issues and keep full control of their funds from Dubai. Before we start, my name is Shiraz Wahid, and I've helped hundreds of entrepreneurs and families move to Dubai, set up their business, immigration, and banking, and legally reduce their taxes. If you want my help in doing the same, you can book a strategy call with me at setupiro.com/call. When you officially leave Canada and declare non-residency, your tax status changes, but your bank accounts do not automatically close. You can technically still keep them open, and many Canadians living abroad continue to use their accounts. But there is a big difference between what's technically allowed and what's smart from a tax and compliance perspective. The first thing that you need to understand is that Canadian banks are not required to close your account when you become a non resident. However, the moment you notify your bank that you're no longer a Canadian resident, it may change the type of your account that you hold. In some cases, the bank may switch it from checkings account to savings account or to a non resident account. These accounts often have higher fee and fewer benefits. The next part is the legal side. Under the Canadian tax law, becoming a non resident means you're no longer taxed in Canada on your worldwide income. But CRA may still monitor your ties to Canada. So if you continue to use Canadian address, keep a Canadian driving license, or maintain too many financial ties like saving plans and investments, or frequently use local bank account, the CRA could challenge your non-residency status. This is where people make costly mistake. They leave the country and assume that they're done with the Canadian taxes, but continue to use their Canadian bank accounts like they never left. That pattern of behavior can create a residency tie to Canada. And if the CRA decides that you still have strong ties, they could assess taxes on your global income even while you're living abroad and any money that you make while you're in Dubai. Another issue is reporting. If you're in Dubai and you're a fully non resident in Canada, you have no obligation to report your foreign income to CRA. But if you leave a footprint through banking activities in Canada, especially with large transfers or investments, it could trigger a review. It doesn't mean you'll be taxed automatically, but it does raises questions. Now, let's talk more about a practical challenge that's the banking access. If you're living in Dubai, you might find it inconvenient to deal with Canadian banks. Some online features might get restricted, and in some rare cases, bank may ask for Canadian address to maintain the account. And this puts you in a tricky position because if you use friends and family members' addresses, that again becomes a residency tie. So, what's the right way to handle this? You can keep a Canadian bank account open as a non resident, but you must be strategic. First, you need to notify your bank and update your records with the Dubai address. Second, limit your Canadian accounts to essential transfers. Avoid using it on everyday local accounts. And third, you need to close unnecessary ties like Canadian credit cards or tax free saving accounts, especially if you're no longer benefiting from them. It's also a good idea to open local bank accounts in Dubai. So you can receive your income there, invest locally, and use the Dubai residency to benefit from Dubai's zero tax environment. Remember that in Dubai, there is no personal income tax, no capital gains tax, and no tax reporting to CRA if you are fully non resident and no longer have Canadian sourced income. Many of our clients choose to set up a free zone company in Dubai to generate business income and qualify for a residence visa. With proper planning, this allows them to declare non residency in Canada, eliminate global tax exposure, and legally reduce their taxes to near zero. The 9% corporate tax in Dubai only applies above 375,000 dirhams in profit annually, that's close to 100,000 US dollars, and personal income remains tax free. If you do it the right way, you can enjoy full access to Dubai's banking system, asset protection, and business friendly laws while keeping minimal footprint in Dubai. That gives you best of both worlds, safety and convenience without triggering a tax audit. There is also a question of investment accounts. Registered retirement saving plans or RRSP can stay open and you won't face withholding tax on growth inside the plan. But once you start withdrawing, you will be subject to a 25% non resident withholding tax unless a treaty applies. Also, the tax free saving accounts or TFSAs are a different story. You cannot contribute after becoming a non resident, and the tax free status may not be recognized by your new country. In Dubai, it does not matter since there is no tax, but in other jurisdictions, that can create confusion and penalties. From a compliance standpoint, the most important thing is to ensure that CRA accepts your non residency claim. That means cutting ties clearly and proving that your center of life has moved abroad. Dubai helps in this regard because you can get residency visa, rent a property, and set up a company and show economic activity. Once you are clearly a non-resident, make sure to file a final tax return in Canada indicating that date that you left. Inform your financial institutions, including your bank, brokerage, and the CRA. After that, your reporting requirements in Canada will be limited to specific situations, like if you're receiving Canadian sourced income or disposing taxable Canadian property. In Canada, the personal taxes can go over 50%. In Dubai, there is no personal income tax at all. Unlike the CRA rules, Dubai has much simpler tax system. This makes it much easier to separate yourself from your old tax residency and start fresh. If you're planning to move, you must also think about the exit process from Canada. You may be subject to departure tax or exit tax on certain capital gains. It's best to review your investment portfolio before you move and take advice if you hold significant assets. Once you exit properly, the focus shifts to staying non resident and protecting your new tax status. This is why we help clients not just set up in Dubai but also cut their ties to Canada in a legal and strategic way. We look at the full picture: the taxes, visas, bank accounts, and compliance. So, if you want my help in setting up your Dubai company, residency, banking, and exiting the Canadian tax system, you can book a strategy call with me at setuphero.com/call. We'll go through your situation and build a clear action plan that works for you. And if you're serious about using Dubai for your business and investments, you should really check out my next video right here.